Hello everyone and welcome back to another video where we're going to be detailing Fisher's growth stock strategy. So Fisher's growth stock strategy is a little different compared to that of Warren Buffett. So what Fisher is really doing over here is that he's looking for stocks that have strong growth potential such that they can warrant exponential growth over a long period of time. So it's not just short-term growth that'll just quickly happen and then fizzle away in just a little snap of a finger. Instead, we're going to be talking about growth that can continue to occur over a long period of time. So Fisher's growth stock strategy involves several key questions. For example, does the management have the ability to continue to produce new products and innovate, or does the company have an effective research and development team? So here are several of the different things that Fisher looks for. So number one, does the company have good sales team? Does the company have high profit margins? What does the company do to improve said profit margins? And does the company have a good relationship with its workers and along with strong executives? So what Fisher is really doing over here is that he's looking at a company and he's looking at the different metrics that govern the growth of the company. He's looking at, for example, the profit margins, sales teams to see whether or not that their sales marketing can expand the company's exposure to the public. He's seeing whether or not profit margins can expand. So what he's really doing is that he's looking at the different metrics that govern profitability and growth within a company, and he's really capitalizing off of that. So this is a little different from value-based investing in the sense that as opposed to value-based investing, which is based on fundamental analysis, which is all about picking stocks that are both undervalued and have a high growth potential. Fisher cares more about the growth potential as opposed to the valuation of the company. So remember how in the previous video I said that in today's stock market, with a good degree of overvaluation being dominant within most of the market, a lot of people are saying that value-based investing needs to be modified or shifted a little bit to account for that. So Fisher's strategy can be thought of as an example of such a shift or such a modification in the line of thinking. So Fisher cares more about whether or not the company can continue to grow as opposed to what the company is valued when he is buying said stock. So yeah, so I introduced this alternate idea of value-based investing in the previous video to give the perfect introduction to Fisher's strategy. So Fisher's strategy is all about finding a growth stock with strong growth potential and then seeing whether or not that potential will continue to be there. It doesn't matter if the stock is overvalued or not. If the stock is overvalued, but it still will grow, that means that people will continue to buy this asset because uh, at the end of the day, the stock still remains attractive. And we can see this with several of the big tech stocks or FANG stocks, for example. A lot of them are overvalued, but they still have growth potential, which is one of the main reasons that people still invest within them. Fisher's strategy basically applies that same principle to whatever stocks he is looking at. And at the end of the day, if overvaluation does go over the roof, but growth potential also goes over the roof, and growth potential is no longer there, then overvaluation becomes deadly because all of a sudden we have a stock that's not worth a whole lot, but it's trading for a whole lot. So it doesn't really make sense to pay that price on the market, which is why people are motivated to sell. So that's the key breakdown behind why overvaluation when overvaluation can actually go wrong. But Fisher's strategy is just a variant of that general line of thought where you look at a stock that's going to be growing for the long term and you buy into it. So once again, to sum it all up, Fisher's strategy is all about looking at the different components of a company. We look at their profit margins, sales team, look at the relationship with workers and executives, research and development, and whether or not they can produce new products. We basically look at all these different channels and avenues that govern the growth of a stock. And from there, we decide whether or not we want to buy or sell, such that we can use that to our advantage. Thank you so much, and I hope that you guys learned a lot.